Hey everyone, me Kevin here. Let's talk Tesla because tomorrow is July 20th, which is Tesla's earnings a day after hours. Stay tuned. It's going to be big. But let's talk a little bit of a preview before that. So Deutsche Bank put out a piece, research piece on Tesla, and they actually issued a buy rating for Tesla before earnings. Listen to some of the catalysts that they talk about. Then we're going to talk about some of the things that I'm finding important regarding Tesla, some of the things that I'm going to be looking for. And of course, we're somewhere here in Munich in front of this fancy building. It drove over here for like 6.5 hours from Dusseldorf. And let's just say I'm happy not to be on the road anymore today. So let's get right into this. Okay, so what do we have here? So Deutsche Bank is calling Tesla a buy ahead of earnings. And they believe that Tesla's a buy because they think the company is likely to end up reporting a big beat on margins over what Wall Street expects. That's because most of Wall Street has been expecting terrible margins for Tesla in Q2 because Shanghai has mostly been shut down. And as a result of Shanghai mostly being shut down, which is the most efficient plant that we have operating right now from Tesla, the expectations for margin are actually quite low. And they believe this sets Tesla up for a potential big beat. They also believe that Tesla's price increases, especially the $2,000 price increase that we had this quarter, is definitely going to help ramp up margins again. Now, I'm a little skeptical here. I've personally been expecting a margin miss, and the reason for that is simply because Shanghai is a better plant. Even though we get Model S's and X's and the Plaids coming out of Fremont, and those are helpful, the Shanghai plant, cost of labor, everything is substantially cheaper in Shanghai. Now, one of the things that I love about Shanghai, though, is the ramp schedule. And for the ramp schedule, I actually jump over to a Barclays report. So we get enthusiasm for a potential margin beat from Deutsche Bank, and we've got a buy rating from Deutsche Bank. But when we jump over to the ramp schedule that Barclays gives, it's kind of interesting. They believe that by 2025, we're going to see Fremont cap out at pretty much where it is now, right around 500 to 550,000 units. They believe Shanghai is going to move from about 775,000 units this year to almost 1 million next year, and then only capping out around 1.1 by about 2025. Germany, they think, will ramp from about 59,000 vehicles this year to 275,000 next, and then 470,000 by 2025. And Austin from 59,000 this year to 234,000 next year, and then, of course, 420,000 in 2025. Now, this actually creates a little bit of a downside risk, in my opinion, because even though this forecast sounds nice for ramping those facilities, the Gigafactory, Berlin, Shanghai, seeing Shanghai's expansion take effect, getting that to 1.1, and then, of course, Austin, Texas, one of the big issues that we have here is that Barclays is only suggesting a growth rate for Tesla of 37% in 2023, 18% in 2024, and just 9% in 2025. Capping them out at 2.5 million vehicles produced by 2025, which is about 1.5 million vehicles less than I'm targeting, somewhere around 4 to 4.5 million vehicles. This is a little bit of a red flag. So while we've got some short-term excitement for a potential beat on margin, thanks to what Deutsche Bank is showing us going into earnings, that longer-term forecast from Barclays, in my opinion, not that great for production. Now, this is where my previous belief about Tesla becomes very, very important. And that is that Tesla cannot keep its price up with these kind of ramp rates. We need to be able to have more gigafactories so that Wall Street starts pricing in that continued 40 to 50% compounded annual growth, at least for the next 4 to 6 years. That would justify Tesla's valuation much better than where we sit now. And so that does concern me a little bit, that Barclays is not at all considering that there will be any other gigafactories between now and 2025. Personally, I think that's one of the things that Wall Street is really missing about Tesla. That what Elon Musk wants to do is ramp Berlin and Giga Texas up as quickly as possible, ramping these and taking these factories from an idea to built within 2 years to fully ramped within 4 years total 2 years, and then 2 years for ramp, and then copy and pasting that model. Because if we do that, then what we could say with Tesla is, all right, let's go into 2023 when we're doing 250K plus at Berlin and Giga Texas. Now, let's get an announcement from Tesla where in 2023 we're going to have announcements for, let's just say, 3 new gigafactories rather than just Berlin and Texas. We get maybe 3 new, whether that's another one in Texas or another one in South America, or the first one in South America, let's say, maybe one in Indonesia, whatever, right? Now we can really get those Wall Street ramp rates up. So that's something that we really want to see hints of on the Tesla earnings call, though unfortunately I think now is a little bit early for that. So while I'm optimistic that maybe Deutsche Bank will be right and that we'll beat on margin with Tesla, personally I think that could be hopium, and I don't think we're going to get any kind of real optimism for future ramp-ups. Now, other investment analysts are suggesting that Tesla is going to do just fine this earnings because they're going to maintain substantial positive cash flow. Although the estimates for this range, we could see a negative $1 billion in cash flow. We could see positive $3 billion in cash flow. The estimates are all over the place. The estimates for earnings are anywhere between $1.40 per share to $2.10 per share. They're absolutely all over the place. But clearly, in my opinion, the big things we're going to be paying attention to: first, margin. Second, do we have any kind of hope for future expansion of gigafactories, and how are the ramps going now? Because the smoother the ramps go now, which, let's be real, no ramp goes smoothly. Okay, these factories are utter chaos until they're actually smoothly operating. Ramps suck. Then the more potential excitement we can get for future gigas. But I really don't think Q2 2022 is the time for any kind of future company expansion plans. Another thing, though, that we'll obviously be looking at in the press release as it comes out is any kind of Bitcoin impairment. Right now, we're expecting somewhere around $400 million in Bitcoin impairment, though that's not a cash flow effect. That will be an EPS, an earnings per share effect, but we won't see that in the free cash flow. We'll be able to look at the free cash flow number on the cash flow statement, and we'll be able to see that, okay, they have some paper losses in Bitcoin that get added back in to free cash flow, which is important because we want to see Tesla's working capital be very, very high. Remember what Elon Musk told us in an interview with the Silicon Valley Owners Club. He told us that ramping factories is like throwing money into a furnace. It's literally like lighting money on fire. And what's really important about that is that we separate Tesla from the notion that it could potentially go bankrupt. Remember, we are either in a recession or are going into a recession, or we're basically going to be teetering next to a recession. Even Bank of America is suggesting that we're probably going to have 4 quarters of negative GDP growth, which the fact that we're coming off the sugar high is really no surprise anyway that we're going to have a little bit of a crash. It's not that big of a deal. If anything, it's an opportunity of a lifetime to invest and to build our wealth in companies that we want to build our share position in, right? Focus on your Q, not your P. Focus on your quantity, not your price, right? These are some of this is just maybe a fraction of a percent lesson of some of the amazing things that you learn with me when you join the programs on Building Your Wealth with that expiring coupon code on the 28th of this month. The 28th of this month, the 50% off coupon code will be going away. We'll be raising the prices again, so make sure you get in before the prices go up because we'll be adding a lot more content. Again, another release, because we just released a large batch of content. We're going to be releasing more content in August as we'll be back in the office and we'll have our big old studio back. So we're excited about that right now. Obviously, we're traveling. And so we are still trying to do our best to bring content and value via live streams and, of course, these public videos and whatever else we can do within answering questions in the courses. So check out those courses linked down below and take advantage of that coupon code. So going now back to Tesla, we've talked about margin, we've talked about ramping, we've talked about Bitcoin impairment and free cash flow and expectations. Very, very important in my opinion that Tesla does maintain positive free cash flow. If we end up getting negative free cash flow, we're going to see more of those concerns again that, oh no, here we go, risks of potential Tesla bankruptcy. You'll get headlines, Tesla losing this much money in the last quarter, blah, blah, blah. And that's going to raise the specter of questions again of why in 2022 does it seem like, at least shout out to Troy Like on Tesla. This is at Troy Like TSLIKE, who does estimates for vehicle deliveries and registrations in both Europe and the United States. Why is it that the pace at which we're seeing registrations of American Teslas, like Model 3s and Ys, why does it seem like that's substantially slowing in 2022 relative to other years? Is Tesla maybe not as insulated from recessionary fears as we'd hoped? And one of the ways we're going to kind of get corroboration on that thesis is, or concern, is guidance from Tesla. So is Tesla going to maintain what Elon Musk told us in Q1, that, hey, we might be able to grow at 60%? I hope so. But again, hopium is not an investing strategy, so we have to be prepared for a potential miss on full year guide. I will tell you, though, that Tesla registrations in Europe, which again go to Troy's Twitter page here to see it, Tesla registrations in Europe in 2022 are ramping substantially faster than in any year prior, going all the way back to 2013. Now, that could be because now we're manufacturing the 3 and Y in Berlin, but I doubt that that is exactly why we're seeing this boost in registrations. What I actually believe is because we're actually starting to see the development of the Tesla supercharger network in Europe. One of the most frustrating things about having an electric vehicle is not having a large enough supercharger network. And it takes time to build the supercharger networks. And so this is where I also am going to want to pay attention to what Tesla is doing on their next earnings release with the supercharger stations. How many supercharger stations are we seeing built? We had supercharger stations in Q1 of 2022 of 3,724, which represented a 38% year-on-year growth. What I want to see is that number actually go up, because I want to see Tesla's, ideally, like best case scenario, Tesla somehow magically pulls off margin, whether it's through price increases or whatever. Then we end up seeing positive free cash flow and more rapid deployments of the supercharger network. That is really important for future sales, and it separates Tesla from all of the competition. So again, we've got supercharger stations at 3,724. I want to see that year-over-year growth rate exceed 38%. Now, the comp that we're going to be facing for Q2 2021 is 2,966. So just do 2,966 times 1.4, which, let's see, 4 times 3 would be about 1,200. That means we'd have to be somewhere around 4,200. We'd have to be opening somewhere around 500 supercharger stations. That would be a little faster than what we usually do, which seems to be around 200 to 300 supercharger stations. So I might be disappointed there, but we'll see how close we get. And that's just mental math there. But yeah, anyway, the next thing that I'm excited about, or going to be excited about, is solar deployment. So we actually had a negative 48% solar deployed growth in Q1. It's not uncommon to see a big drop-off in Q1, usually from Q4, but to see a year-over-year Q1 plummet like that, I don't know what happened there in Q1. So I'd really like to see solar panel deployment up. Certainly year over year. I mean, we've got to beat 85 megawatts. We were at 48, which is paltry in Q1. I don't know what happened there. So I'd like to get a little bit more clarity on the solar ramp, because either homeowners have officially started to pull back their spending on investing in their homes, which will be a catalyst for Enphase stock as well, which ran to like 215. I wanted to short it, fell to 186. I didn't end up shorting. I just talked about shorting it to course members in the course member live streams. And now it's already bouncing back to over, 205, 206 or so today, which is remarkable. It's a great company, and I love Enphase. I just expect that if home appreciation stalls and slows down, that people will spend less on solar and certainly spend less on batteries. Remember, for these 5K battery packs, you're spending somewhere around $10,000 to $15,000 installed. I think Tesla batteries, you're spending $10,000 on the battery plus install, $5,000 in the permit and everything. It's expensive to do these batteries. And I'm not sure if homeowners right now want to spend money on doing the battery upgrades, and that's where the margin is. Remember that when it comes to solar. The margin is not in the stupid panels. It's in the inverters, whether they're micro inverters or string inverters, whatever, or the batteries, or I should say, and the batteries. That's where the frickin' money is. So I do want to see some growth there as well. I don't expect to see anything exciting out of Tesla Insurance yet, although I will tell you, I think the safety score feature that Tesla has is so unique and proprietary, and it is something that absolutely will be revolutionary in the insurance industry in the future. But Look, insurance is one of those products that, even though Elon Musk believes that in the future insurance alone could be worth a quarter of the value of the company, I think that is just pie in the sky hopium at this point. I think what's more pressing in the near term, rather than talking about FSD or insurance or Cybertruck timeframes or all this other kind of hopium crap like Roadster timeframes, semi-truck timeframes, all that stuff is not going to matter, in my opinion, in this quarter. I think actually what matters more than all of those things is what ends up happening with Twitter. Now, I'm going to make some separate videos on Elon Musk and Twitter and some of my thoughts, especially as we find out what the judge ends up ruling in terms of, is Elon going to be faced with an expedited trial in September? Are we going to have a more full-fledged exposure of all of the bot accounts at Twitter, which will probably be more of an extended, like, 1 to 2 year court battle starting in 2023 is my guess, and then that'll go for a few years, and it'll just be a long overhang for Twitter. It'll be terrible, and Twitter will probably end up, if they go for a long lawsuit, I wouldn't be surprised if Twitter ends up caving and we get some kind of negotiated price. Twitter ends up getting sold to Elon Musk for substantially less. Twitter's best case scenario is getting an expedited trial and being done with this. Which an expedited trial would probably be quite bad for Elon Musk, but we'll see what happens there. Again, this isn't supposed to be a Twitter Elon Musk video. Really, at this point, I think Elon Musk has liquidated what he needs to do the Twitter deal, whether it happens or not. And I don't know how much of an effect is left for Tesla there, although we do expect that if the deal doesn't go through, that there should be some residual benefit to Tesla stock, as the investor community does seem to believe that Elon Musk would otherwise be distracted if he did get involved with managing and running Twitter and trying to reform Twitter. So anyway, personally, optimistic. I am also probably going to be selling my Model S Plaid, and maybe we'll trade that in for an X. We'll see. It's one of those weird things where last September I tweeted, don't buy a Tesla, buy TSLA. And that ended up not being the best suggestion, because the cars ended up going up more in value than Tesla stock. Hopefully, this time, though, is different, because those are, after all, the safest words in investing. This time is different. Buy Tesla stock. Okay, not a recommendation, because this video is not financial advice for you, but there is a strong suggestion for you to get educated via the programs on Building Your Wealth. Link down below, especially real estate folks. I think that's our big next opportunity. Most people, what they're doing is they're bundling the Zero to Millionaire Real Estate Investing Group with the Stocks and Psychology of Money group. Folks, thank you so much for watching, and we'll see you in the next one.